Welcome to the Explainer. In the absolutely brutal economics of space, most new rocket companies, well, they just fail. But there's one company that hasn't just survived, it's actually thriving, and it's positioning itself as the only real alternative to SpaceX. This is the story of how they pulled it off. Okay, so let's just dive right in. The early 2020s were basically a graveyard for space startups. All that cheap money from the SPAC boom, that special way companies go public, it just completely vanished. And because of that, companies that looked really promising, like Virgin Orbit and Astra, they just collapsed. But somehow Rocket Lab managed to navigate that storm. So the big question is, how? What did they do differently? To really get it, you have to see how their success came down to two big things: weathering a really tough financial landscape and, at the same time, capitalizing on brand new global demands. So while all its peers were just burning through cash with no real path to actually making a profit, Rocket Lab proved it could hang on. When interest rates went up, investors got super selective, right? But Rocket Lab, these still secured a massive $355 million in funding. That's a huge signal of confidence from the market. But here's the really interesting part. At the same time, all this geopolitical tension gave them this powerful tailwind. The US government literally decided it needed a strong alternative to SpaceX, which gave Rocket Lab this incredible strategic advantage.
But look, their survival wasn't just about good luck or timing. Not at all. It was about a very deliberate and frankly game-changing pivot in their entire strategy.
And this quote from CEO Peter Beck, it just perfectly captures their big aha moment. They realized that just being a cosmic shipping truck for small satellites, that wasn't a sustainable business. The real long-term value was in building the entire space machine from the ground up. So what did they do? They went on a strategic shopping spree. And this wasn't random at all. It was a roll-up strategy to buy up the key component makers that every single satellite needs. So by buying Solero, boom, they controlled solar power systems, which are often one of the most complex parts of any satellite. Then with Sinclair, they owned attitude control. That's the system that lets a satellite point exactly where it needs to. This whole thing wasn't just about adding a little revenue here and there. It was about transforming themselves from just a launch provider into a completely vertically integrated space company that could build, launch, and operate its own spacecraft. They were taking control of their own destiny.
So, the billion-dollar question. Did this massive bet on vertical integration actually work? Well, the financial data, it tells a pretty dramatic story.
Let's go back to 2020. The company was in a really tough spot. Its gross margin was negative 34%. Now, to put that simply, it means for every single dollar they made in revenue, they were losing 34 cents just on the direct costs of building and launching their rockets. That is a common and honestly often fatal problem in this business. But fast forward to 2025, and that picture is projected to do a complete 180. I mean, this incredible turnaround from negative 34% all the way to a positive 34% gross margin, that is the ultimate proof that their strategy worked. They are now making money, proving the whole business model is sound. And this margin expansion happened alongside just explosive revenue growth. We're talking from just $35 million in 2020 to an expected run rate of over $500 million by 2025. And their diversification into space systems, it gave them this crucial safety net. Get this, when a launch anomaly grounded their entire rocket fleet in 2023, the company's overall revenue still grew by over 15%. That's the power of not putting all your eggs in one basket. Okay, so with their core business stabilized and profitable, Rocket Lab is now making its biggest, boldest gamble yet, a direct challenge to the market leader itself. Meet Neutron. It's a much larger, reusable rocket designed to go head-to-head with the SpaceX Falcon 9. But, building new rockets is insanely difficult. The project has seen delays, pushing its first launch from 2024 all the way to 2026. Now, that burns more cash for sure, but it's a calculated risk. They're choosing reliability over speed, trying to avoid that whole fail-fast approach that really doomed their rivals. And here's the thing. They have the resources to take that risk. With a fortress-like balance sheet holding over $1 billion in cash, Rocket Lab has a financial runway of roughly 3.5 years. That is more than enough time to get Neutron to the launch pad without having to make any rushed, panicked decisions. And all of this brings us to the final, and I think most fascinating piece of the puzzle, this massive disconnect between what the company seems to be worth today and how the market is valuing its future. So here's the bottom line. When analysts build financial models based on the business as it is right now, projecting out its cash flows and all that, they value the company at around $4 to $5 billion. But the stock market, it values it at nearly $24 billion. That $20 billion gap, that is the market's enormous bet that Neutron won't just fly, but that it will be a massive success, capturing a huge piece of the market and forming a powerful duopoly with SpaceX. So, it's the ultimate high-stakes question, isn't it? Rocket Lab has flawlessly executed a survival and growth strategy that left all of its rivals in the dust. Now it's betting the entire company on becoming the second pillar of the Western space economy. The question for everyone watching is whether that spectacular future is already baked into the price, or if this is just the beginning of the journey.